consolidates, takes out sell side there. Once a stop run occurs, the market should expand higher. It does, rips through that premium fair value gap that we would expect to see it trade to. And look at that. Look at the bodies respecting the high end of that inversion fair value gap. It does not need to trade down into it. It can. But these are instances where sometimes when you'll see me doing my executions, I'm recording it, I'll say it's better for these inefficiencies or that particular fair value gap to remain unfilled. We want to see this be treated as a measuring gap or a breakaway gap. So it's only necessary for me or you to see this area right in here provide support. We're seeing that in the body's close and the body's opening and then protraction. The inefficiency here doesn't look inefficient on the lower time frame hourly chart, but it was based on what? The daily chart. So you have to transpose those levels on your lower time frames. Otherwise, you'll lose all the plot, narrative, and storyline behind why price should be reacting or drawing to specific levels. So that right there would have been an area where I would add, if I was trading E-mini S&P and looking for a reason to go long and add more. Say, for instance, say you bought the breaker down here, and you wanted to see it rip through this fair value gap. Anyone that simply looks at gaps in price charts now, and they think that every inefficiency is a buy or sell, they lose the idea of knowing where price is ultimately trying to reach for, which is the number one rule I teach as my students coming in. I press that very hard as your main focus, because it's going to be the one that you're going to utilize for the rest of your career, that gives you all the comfort and confidence to know what you're doing and how you're operating, being bullish or bearish. Bias comes by understanding where the higher time frame weekly draw on liquidity is. You can't watch a video and there's nobody else out there going to show you a real shortcut, always a winner approach. It takes time understanding price action. What is it reaching for? And this is enough to warrant an expansion higher. And until we find it providing support, remember this red line here is the high of that fair value gap. Let me go back up into the daily chart. I'm going to show you this little area right here where these two candles right there are occurring and finding support at the high end. It's this. It's that level right there, which is the high of that fair value gap. And we're expecting price to go higher. So we're not looking for it to go up to here to go down. That's not the 2022 model. Okay, we're using this as a stepping stone or a rung on the ladder to provide us a reason to see more injection of higher prices. So we see that occurring right there. So that's a really good signature. Even if I didn't take a partial entry and scaling in with like a pyramiding position, by seeing that, that comforts me in terms of being on side. So I can anticipate the market reaching up into that buy side liquidity over there. And it reaches up into it, and look at the bodies respecting what? That old high. Yes, we wick through it. Yes, we fall just short of the weekly volume imbalance, but we're not trying to demand that it gets there. We offer ourselves up the opportunity for a best case scenario should it trade there, but we're open to the idea that it may need to do that the following week because it's doing this on a Friday. All right, S&P 15-minute candlestick. You can see a really good illustration of that run into that inversion fair value gap. Hits it and rallies. Inefficiency trades down into it here at the open, rips higher, consolidates, trades higher once more, digs into, and I showed you execution on Twitter